What's up, everybody? So far, Zillow and now Redfin have shut down their iBuying programs, and Opendoor is in serious trouble. On November 2nd, Opendoor CEO and co-founder Eric Wu shared this email with his Opendoor teammates. "We've made the difficult decision to reduce our team by approximately 550 people across all functions, approximately 18% of the company." And Inman reported on November 21st that Offerpad may be delisted from the New York Stock Exchange. The New York Stock Exchange is threatening to boot Offerpad over plummeting share price. In this article, it says that Offerpad received a notice of non-compliance from the exchange, indicating that the iBuyer was in violation of a requirement that listed stocks remain above $1 a share. This is serious because investors often treat delisting as a sign that a company is in serious financial trouble and possibly may be heading towards bankruptcy. Offerpad said in a release that they intend to reverse declines in share prices and return to compliance with the New York Stock Exchange, adding that they are currently considering multiple options, including a reverse stock split upon approval by investors. Even if this is true, Inman reports that though technically possible, such a stigma can further sap investor interest in the company and exacerbate the problems that led to delisting in the first place. So it looks like Offerpad is also going to start offloading all their inventory, just like Zillow and Redfin. We continue to navigate through this period of market dislocation, Offerpad CFO Mike Burnett said in a November 2nd statement. By appropriately managing down our inventory levels and strategically acquiring homes that reflect current conditions. With Zillow, Redfin, Opendoor, and Offerpad all in trouble, it's no wonder investors are really starting to pull back. But how does this directly affect the future of the housing market? Will prices come down dramatically as a result? When looking for articles to share with you guys about this, I found so many from so many different sources. Take a look. Fox Business News, CNBC, Redfin, Realtor.com, and more. So let's just sum them all up and see what they're saying. And of course, I'll give you my opinion as well. So let's just dive right in. So as all of the headlines suggest, investor home purchases fell 30.2% year over year nationwide in the third quarter, the largest decline since the Great Recession, aside from the second quarter of 2020, when investor activity plummeted due to the onset of the pandemic. This is even more than the 27.4% drop in overall home purchases nationwide. The investor share in the overall market also fell to 17.5% of all sales, from 18.2% a year earlier. This is still slightly higher than the 15% share seen before the pandemic. In dollar terms, investors bought $42.4 billion worth of homes in the third quarter, down 23.6% from $57.6 billion a year ago, and down 30.5% from $61 billion one quarter earlier. It is unlikely that investors will return to the market in a big way anytime soon. Home prices would need to fall significantly for that to happen, said the senior economist at Redfin, Shahar Bakari. This means that regular buyers who are still in the market are no longer facing fierce competition from hordes of cash-rich investors like they were last year. Well, it's too little too late for most buyers because interest rates are too high to make buying a home affordable. That, coupled with prices that are still super high compared to pre-pandemic levels, make it nearly impossible for buyers to afford to buy a house today. So which metros are most affected by this investor pullback? Ironically, the places where investors are pulling back the most are the same places that boomed over the last 2 years, because that's where they bought the most homes, especially with these iBuyer programs. Redfin names Phoenix, Portland, Las Vegas, Sacramento, and Atlanta as the top 5 metros with the largest declines in investor home purchases for the third quarter of 2022. And also, just FYI, most of these investor purchases are single-family homes. They lost the most market share in Phoenix and Charlotte, North Carolina. In Charlotte, investors bought 1/4, 25.2% of homes purchased in the third quarter, down from about 1/3, 32.3% from a year earlier. In Phoenix, they bought 25.8% of the homes purchased in the third quarter, down from 31.9%. Overall, investors had the highest highest market share in Jacksonville, Florida, where they bought 29.6% of the homes purchased in the third quarter. And next is Miami, where they bought 28.9% of the homes purchased. But even though investor market share is the highest in Jacksonville, Florida, investors bought 31.9% fewer properties than they did a year earlier. So now all these investors are looking to offload all of their properties before they lose significant value with this changing market. All of my listings right now are people looking to sell investment properties or second homes. Heather Caryn, a Redfin agent, said they want to get rid of them now while they still have some value because they're scared there's going to be another big crash. So the big question is, with all these iBuyer companies either shut down or in serious trouble and investors offloading their inventory as quickly as possible, will this create a significant, fast price drop across our country? Last week, Redfin announced it's shutting down its iBuyer program and laying off 13% of its staff. They also said they are slashing prices on their homes for sale in various markets, anticipating a much sharper decline in home buyer demand. Redfin isn't alone, however. In a move to offload some of the homes in its inventory, Opendoor has slashed prices and offer bonuses to buyers' agents. In Phoenix, Opendoor and Offerpad are some of the main iBuyer players. Jason Lewis, a data scientist and co-founder of real estate platform Parcel Labs, a company that combs and analyzes data on iBuyer activity in the Phoenix area, said that these iBuyers, who currently account for 4.1% of active inventory in the Phoenix metro area, are cutting home prices every 14 days by 2%, equating to more than $90 million in combined losses. If the other non-iBuyer sellers want to compete, they're going to have to cut their prices as well. This will make prices drop much faster and more aggressively than if it was just the normal one seller coming on the market at a time. While Lewis says there is a long way before homes become affordable, Parcel's data does suggest that iBuyers could influence a much steeper price cut across the country, translating to greater housing affordability for many home buyers. If you guys found this to be true where you live, because here's the thing. According to Redfin's latest housing market update, which covers the 4-week period ending November 20th, on average, 7.3% of homes for sale each week had a price drop, up from 3.4% a year earlier, but down slightly from the previous 2 weeks. 7.3%, it's just not that many homes that are reducing their prices with all this news out there. And the average sale to list ratio, which measures how close homes are actually selling compared to their list price, fell to 98.5% from 100.4% a year earlier. 98.5% says to me either sellers are pricing their homes appropriately or there just hasn't been a significant price drop yet in most areas. But comment below and tell us what you see in your area. Are you seeing a lot more inventory? Are you seeing a lot of homes with signs price reduction in front of them? Have prices gone down a lot where you live? Here in the DC area, prices just have not gone down significantly, and we still have very little inventory. Being the holiday season, I don't really expect much to change in the next few weeks, so we'll have to see what the new year brings. Other takeaways from Redfin's latest data are: pending home sales are down 35.2% year over year, the largest decline since January of 2015, which is as far back as the Redfin's data goes. So a lot less homes are going under contract. New listings of homes for sale were down 20% from a year earlier, one of the largest declines since the beginning of the pandemic. Active listings, the number of homes listed for sale at any point during this period, were up 11.6% from a year earlier, the biggest annual increase since at least 2015. So inventory is increasing because homes are taking longer to sell, not necessarily because new houses are coming on the market. This is a very important information because it really puts things into perspective. Months of supply, a measure of the balance between supply and demand, calculated by dividing the number of active listings by closed sales, was 3.5 months, the highest level since June of 2020. Homes that sold were on the market for a median of 36 days, up a week from 28 days from a year earlier, and up from the record low of 17 days set in May and early June. The bottom line is that things are definitely continuing to correct, but the housing market has not crashed in most parts of our country. But I think the next few months, especially starting in the new year, will tell us a lot, especially when all this iBuyer inventory hits the market. Tell us what's happening where you live. It is the best way for all of us to really see what's happening in the housing market across our country. Are you seeing more inventory? Are you seeing some Redfin, Opendoor, Offerpad, signs on homes for sale? Are you seeing a lot of price reductions, or are you still seeing multiple offers? Definitely comment below. Tell us where you live and tell us what you see. I hope you got some value out of today's video. I really think it's super important to bring you the most up-to-date information on the housing market so you can make the best decisions for you and your family. And if you want to see other housing market videos, definitely check out the next two because they're all from different sources. And if you'd like to show our channel some support, definitely smash that like button and consider subscribing to our channel. It just motivates us to make more videos. Thanks for watching. I do appreciate it. Bye!